the panelists for the discussion. Thanks everybody for being here. I'm very excited. This is again on capital markets and private equity. My name is Acha Leke with McKinsey & Company. What I thought I would do is literally in 5 minutes give you the 5-minute version of a 120-page report called Lawrence and the Move 2. I may just stick to the executive summary page actually. And then have a conversation with our panelists. Many of you should know them. Oscar Onyema, who's the CEO of the Nigeria Stock Exchange, and also the chair of the African Securities Exchanges Association. Prej Nagan, who's the head of primary markets at the JSE. Dudley Colby, who's the head of Actis, private equity. And Conrad Rose, who's regional managing partner for Africa for S&P. Right, so that's the panel. We'll get to them quickly. But the 2-minute version on Lions on the Move, I don't know if you can see it very well, but we put out this report about probably 6 months ago now, it's now a bit more, where we really looked at the business opportunities across Africa. And the reason we did it is 6 years ago in 2010, we put out the first report, and it actually was extremely well received. And we really focused on the opportunities of the continent versus all the risks which we all know about. And 5 key messages from here, and honestly, I'll probably just stick to this executive summary chart. One is, we've all talked about it today as well, growth has slowed down. You know, it's starting to pick up again. But the reality is when you look at the story, it's just a lot more nuanced, right? Everybody talks about how we are now the 3rd fastest growing region. We went from 5.4 down to 3.3 average growth in 2015. But it's much more nuanced. If you look at, you know, the Arab Spring countries, they've not grown at all over the last 5 years, relative to 5% growth in the 2000s. Look at the oil exporters, growth has halved effectively in the Nigeria, Angolas of the world. But in all other countries, growth has actually accelerated, right, from 4.1 to 4.4%. So as much as 6 years ago, everywhere you looked, you know, 6 years ago when we did this analysis, we looked at the 30 economies that account for 97% of Africa's GDP, and all 30 countries were growing, and 25 of the 30 economies had actually accelerated their growth relative to the 1990s. Now, if you look at the 30 economies, 13 have accelerated the growth, but the top 6 have actually declined, right? So, again, it's quite positive, but it's much more nuanced. More interesting to us is when you look at take a forward-looking perspective. If you look at the fact that Africa, you know, will have the largest workforce in the world ahead of China, and more importantly, that stable jobs are growing faster than the labor force for the first time, right? So you're starting to see a trend there. Secondly, you look at the consumer. The urbanization story, we are the fastest urbanizing region in the world. On average, 24 million Africans are moving to cities every year for the next 30 years. And the urban African is 2.5 times more productive than the rural African, right? Again, another trend that has left the station. Third, you look at technology. Technology is fundamentally transforming. We talk about mobile payments in Africa, but every single sector you look at, whether it's retail or education or infra, look at what's happening on the energy front as well, fundamentally changing and allowing us to leapfrog. And then fourth is that, you know, we still have these resources. We're still in many ways a cost competitive location to source these resources. And, you know, prices have started to stabilize and come back up. So for all those 4 factors, actually, we as McKinsey are quite positive and bullish about, you know, the Africa's future. And if you look at any other projections, IMF and these projections, we're still projected to come back to be the 2nd fastest growing region in the world, right? So much more nuanced, but if you take a forward-looking perspective, you know, quite excited about the continent. Second point is on the business opportunity. And there, the interesting thing is, and maybe I'll need one slide quickly on the business opportunities. We sized both the consumer, the B2B and B2C. We found $4 trillion of opportunities for all of you in the room, right? Growing to $5.6 trillion. Interesting on the consumer front is actually the shift in that opportunity. This looks at how much of the consumer spend is represented by the country or the region, right? So Nigeria used to account for 26% of the consumer spend. We project is going to continue to account for 22%. But interesting thing, you look at South Africa is going down from 15 down to 12%, at the expense of East Africa going from, 12 to 15, Francophone Africa 9 to 11. So real, you know, where the sources of growth are changing fundamentally. And what I always say, but I'm not from Nigeria, I'm from Cameroon, but whatever you say about Nigeria, right, it will continue to account for over 20% of African consumer spend, right? So if you're in the consumer-facing space, you cannot avoid being in Nigeria, right? So that's the consumer fundamental shifts in consumer trends, and that has implications for our consumer clients, the products they serve, the countries they're in. On the B2B front, again here, South Africa and Nigeria account for about 40% of the B2B spend. What's more interesting on the B2B front is more the types of companies you serve. The dark blue is the companies over $500 million. The light blue is companies less than $500 million in revenue. What you find is that it's actually quite different. So the way you have to structure your workforce to go after the opportunity in Tanzania, where 90% of the companies are, call it SME type, versus South Africa, where over 90% are large companies, is very, very different, right? So that's a lot of what our clients are thinking about, how to structure themselves to go after that opportunity. Manufacturing, very quickly, completely underperforming as a sector. We're growing at 2.5% for the last 15 years. China is growing at 15% year on year. Vietnam at 13%. We started by just saying, how much do we even manufacture in Africa today? We couldn't find the data, so it took us about 3 months to build a database, and now we can tell you we manufacture $500 billion worth of products in Africa today. 70% are manufactured in-country for in-country consumption. 10% manufactures in-country and exported across Africa, which sort of ties with the 12% intra-Africa trade, and about 20% manufactured in Africa, exported across the rest of the world. We think that could double. There are a number of things that need to happen for manufacturing to double. But there's huge opportunity to actually double manufacturing. There's a lot of focus that's been happening on that. One key thing is increasing productivity. We always talk about how Africa labor force is low, is cheap, right? And how the 80 million jobs that will be delocalized from China will find their way to the continent. What people tend to forget is that it's not just labor force, it's also productivity that have to come together. And in many cases, we're not productive enough, right? So a lot of the recommendations around how to increase productivity, how to build bigger markets and all of that. The fourth chapter is on companies, right? We've built the largest database, which we believe is the largest database of companies with revenues over $500 million and above. Now, I don't have time to ask you this question, but those who've been to my presentations, I always ask, how many companies do you believe make $1 billion or more in revenue in Africa today? How many companies? And inevitably, the answer is typically people tell us between 50 and 150. That's the typical answer we get. The truth is there are 400 companies in Africa that make $1 billion or more in revenue. And obviously the only 2 people who've gotten it right out of the 2,000 or so. One is Aliko Dangote, which is interesting. But the 400 companies that make $1 billion or more in Africa, now we can slice and dice it in a bunch of different ways. What I think is more interesting to you all is, half of them are in South Africa, by the way, 20% in North Africa. More than half of them are actually just African companies, right? So 56% are local African companies, 17% are state-owned enterprises, about a quarter are multinationals. And now that we've been able to slice it, we then looked at the list, and about 40% are listed. We'll talk about that. And for the listed ones, we were able to compare them to the peers around the world. And we can now show that companies in Africa grow faster and are more profitable on a local currency basis than their international peers, right? We have the data for that. But they're not enough, and there are a number of reasons why we don't have enough large companies in Africa. There's no single African company on the Fortune 500, right? There are 7 Indian companies, 9 Brazilian, 100 Chinese. There's no African companies, right? So that's where we stand, but a lot to be done, and there are a bunch of reasons, small markets, and some of the reasons we know, but we really need to create a bigger market. So final slide is just recommendations that we need to do. That's not just governments, but as a private sector as well. Mobilize our own domestic resources, absolutely critical, right? And a lot of what with pension fund money locally, for example, will be important for that. Diversifying our economies, we're way too dependent still on commodities, about 20% up to 2010. Of the 2000s of the growth came from commodities. We need to diversify so we can have more than one pillar for many of our economies to stand on. Infrastructure, I think we've spoken about it quite a bit today. We've grown from 60 billion a year to 80 billion a year in infrastructure spend, which is great, but we need to get to 150. That's what's needed. How do we get there, and how do you attract private sector especially to come and do that with you? Regional integration, we through this try to make more the business case than the political case for regional integration. It's important to have large companies. For large companies, you need big markets. In every country we looked at, the top 100 taxpayers account for 60 to 70% of the tax revenue, right? The top 100 taxpayers. And then they formalize the supply chain as well, right? But it's important to have big companies, and for that, you need bigger markets. Talent is absolutely critical. We think vocational training is the way to go. It's only up 8% of Africans who go to vocational institutions. We think it should be more like 50%. Urbanization, healthy urbanization. I talked about the 24 million Africans moving into cities every year. We need to make sure our cities are ready to receive them. And then finally, we absolutely need a step change in the sort of quality of the public sector leaders and institutions. That's my 7-minute version of my 120-page report. We have 5 minutes. I'd suggest we take a few questions all at once and then get the panel to answer, and we'll close. Looks like there's a question right here. Do we have a mic? Any other questions, by the way?
I'll start we know, at least according to your competitor, Moody's, that in their database study of I forget how many thousands of deals over 15 years, that properly structured project finance transactions, which is part of what we're talking about here, right, actually perform better than other instruments. Because as we know, project finance structures are ring-fenced, they're for essential services, there's a lot of credit factors that can explain that. Moreover, in their March 2017 update, they said that irrespective of the location of the project, there was resiliency given shifts in the macro environment. Now, I know my friends at S&P have done hard work in the same area, so I'm asking you for your independent comparative viewpoint on the validity of that finding. Thank you.
All right. Other questions before? Any others? None? Going once, going twice. There's one here.
I was just hoping you could elaborate on your statement about the Africa, going from Africa Rising to a multi-speed Africa, and whether you think that is creating opportunities we should focus on as a differentiator, or whether you think all in all that's going to make this a scarier place to invest. I know a lot of people in the U.S. think of Africa as a country, unfortunately, and don't differentiate that Botswana is different from Uganda, is different from Nigeria. So just wondering if you're looking to get institutions engaged in Africa and we are going to a multi-speed world, what would you focus on now in terms of the challenges and opportunities?
Yeah. So the risk of starting anyway, Conrad is all the questions we geared at him, but if you can take that, and Natalie, I'd love to hear your points around this multi-speed Africa as well, if you agree with that. Conrad.
Good. Perhaps I'll start with the question around project finance. And yes, I would fully support the argument, or we at S&P, we fully support the argument with regards to resilience of project finance. We've done a study, we looked at 573 rated projects around the world, and the default rate of the projects was actually quite low. It was actually only at 7%. So out of the 573 projects we rated, 39 actually defaulted. That is, I would say, that's a fairly small default rate, and in the context of like the challenges we have seen, quite a low default rate. Now, you also made the point that some of our competitors not only look at the actual default rate, but also look at the sovereign or country environment, and I'm not in a position to comment on what our competitors opine on in terms of like how country risk impacts on project risks. For us, that still is a significant constraining factor. There are ways to overcome call it the sovereign constraint, or some in the market like to call it the sovereign ceiling. But we still believe there is justification in looking into this. You have to remember, if you're in a given country, for your project, a respective sovereign might be the off-taker. The respective sovereign is involved in writing regulations, setting the regulatory framework, setting the legal framework. So there are many ways how a sovereign in a given country, where a given project might be, will impact or can impact on a project. So a sovereign constraint, in our opinion, is a valid argument.
Yeah. Natalie, do you want to talk about the multi-speed?
Yeah, no, it's a great question. It's something obviously we get asked as investors in Africa all the time about, how do you manage the risks? I mean, I suppose the interesting thing is that we often see that investment returns is not always correlated to macro shocks. In fact, it's often it's uncorrelated, and you're often able to make better investment returns in an environment where there are some shocks, because often those shocks therein lies the opportunity. And we've just got a very recent example now where we exited a snack food business in Egypt. We invested in that business at a time when Egypt was going through the Arab Spring. Recently, the Egyptian pound has basically lost 50% of its value overnight, and we were able to exit it with a 40% plus dollar return. So it's not always correlated. The way that we access opportunities on the continent is we look at the theme or the sector theme first and who our counterparties are, and then we'll have a look at the macro. It doesn't mean to say that we're immune to the macro. The macro is obviously there, it does impact on it. But if for any of us, if you wake up in the morning, you're sending your kids to school, if you're sick, you're going to hospital, you're buying your groceries in the stores, regardless of what necessarily is happening at the macro level. And it's really finding those secular growth trends which are uncorrelated to GDP growth, where we need to find the investment themes from. And yeah, I mean, as I said, we've actually, even recently in South Africa, we exited an investment in Taki Town, which is a footwear retailer, in an environment where the retail market has been, consumer sentiment is low, the retail market has been pretty flat, and again, an excess of 30% dollar return there in an environment where the rand has depreciated. So it's really finding the micro below the macro, and then you're relying on the manager, and their local insights, their footprint, and their ability to find those opportunities.
Good. And one last question, and then we need to close. Oh, well, there's a lady too. Okay, two last questions, very quickly, please.
Okay. You spoke about the need to integrate better, deeper, the economies in the continent so that there is a greater market for companies to develop in. But this is, I think, it's still rhetoric because we have a lot of frontier issues in the continent. And I know for a fact that, for example, as a Senegalese citizen, I can come to South Africa without a visa, whereas as a French citizen, because I'm both, I can without. Yeah. So the country is more open, which is an economic fact to maybe foreign economies than it is to its neighbor. But now that it is turning to actually developing the continent further, how do we also really integrate these different economies and countries, overcoming the barriers of those issues that we are far closer to our long-distance neighbors, I'd say, than to our African neighbors.
Okay. And then one last question at the back. Can you just pass the mic to the lady at the back? Thank you.
Thank you, Mr. Conrad. I'm not too sure if the question is relevant or not, but I just wanted to understand from past experience, how did S&P rating changed for the neighboring country of the country that is downgraded to junk status and that has strong trading partners with such a country historically? Yeah.
So on integration, I'd love to hear maybe from you, Oscar, about ASEAN and what you guys are doing to try to integrate the stock exchanges, and maybe if you want to talk about that press as well from the JSE perspective, and then Conrad, you can end with the question on impact on neighboring countries.
Mm-hmm. Okay. On integration, the ASEA is actually driving a move to get the bigger exchanges across the continent together to create a much deeper pool of liquidity. And the reason why we're doing that is that if you look at the sub-regions, South Africa has SADC, East Africa has the East African Community, West Africa has the West African Capital Market Integration Effort. These are small and medium exchanges by and large coming together and trying to get their ecosystems together. And we're not getting the same kind of traction as we hope to get when you have the major hubs, Johannesburg, Nairobi, Lagos, Casablanca, Mauritius, coming together. And so that effort is ongoing with the full support of the African Development Bank. And we are leveraging the experience that we've had in the sub-regions and in other regions like ASEAN and Asia to see how we can pull together these markets and create a deeper pool of liquidity that will attract investors and investments across the continent. Now, it's very important to note that one of the reasons why we're doing this is to drive easy movement of people, easy movement of goods and services, and easy movement of money. We think that if we can get people trading within the continent, that would really make the continent a more attractive investment destination.
Yeah. JC?
So just to add to that, I fully agree with you, Oscar. I mean, the truth is that we all need to do a little bit better. The fact is that if it is difficult to passport people around the country and goods around the country, it does make doing business from a regional perspective very difficult. So, obviously encouraging to hear that work is being done with the ASEA linkages projects and other work being done with the exchanges. Certainly from, a capital markets perspective, various African exchanges have the disadvantage of not having many companies listed on the exchanges, which obviously impacts liquidity, it impacts the capital markets in those regions. And there's certainly also work being done to integrate those exchanges to improve liquidity as well as products. For example, Oscar mentioned ETFs on the continent, which in of itself should help improve the liquidity of the underlying assets which make up the ETFs on the continent. And those are on the increase. The JSC just saw an Africa Big 50 ETF listing, which tracks sort of the top 50 companies on the continent. So, hopefully, as we see more and more of these products coming to market, it'll help to improve the liquidity and I think the capital markets across the continent.
Cool. Conrad?
Yeah, just back to the question regarding sort of knock-on effects from credit downgrades or weakening of credit in a given region. The observation would be if the weakening is fairly moderate and well managed, one doesn't have to see a lot of sort of knock-on effects on neighboring countries, even if there were to be many sort of trade links and all of that. It gets different, and it gets different very quickly once it's an outright crisis. I mean, look around the world. We had the Argentina crisis, and very quickly Uruguay became a collateral damage along the way. Look even at the European debt crisis. Once you had a debt crisis unraveling, quite a number of countries were caught up in that situation. It's very hard to imagine that a country like Spain has a debt crisis or a credit crisis, but a small country like Portugal next door wouldn't. So yeah, depends on the severity of the crisis. I obviously understand, for instance, now in this part of the world, South Africa is not doing well. That has implications on Namibia, for instance. We don't have a rating for Namibia, but I can hear that there is quite a bit of stress in the system in Namibia because of the knock-on effects that are coming from South Africa.
Yeah. And to end on a positive note, on travel for Africans, 5 years ago, there were only 5 African countries that allowed any African to show up without a visa. Either you could get on arrival or you didn't need a visa. We've been working a lot at it for the last 5 years. Today we are at 15 countries, right? So we're making some progress, but still ways to go. Please join me in saying thank you to our panel.
Doing business in Africa, you can't afford to be without Africa Investor.